The truth is, nothing in the next 30 seconds will help you make the most important decision of the season, or any decision you'll make this year. This commercial can't deal with tough challenges in your fields, your office, or in town. You already know that. You don't want to be sold to. You want an experience that yields results. You can't get that from a commercial. You can get it from your channel seedsman. Text YIELD to 242-665 to get agronomy advice you can take into your fields.
This is Matt Bennett, grain marketing consultant with Channel Seed, and basically I'm here to talk grain marketing 101 again this year. I know it's a virtual presentation, so a lot of you folks are turning in on your computers. And what we're going to do is we're just going to go over some basics of grain marketing and then get into some more specifics as well. But I understand with some of the years we've had, in recent history, it's been a little more challenging to market grain. And then you come into a year like 2020 into 2021, and you think that the marketing is going to be significantly easier because prices have gotten a little better, and you find that actually it hasn't gotten much easier at all. So we're going to try to get into grain marketing a little bit and just talk about some of the basics that I think can help you as far as your operations concerned. Just three basics that I'm going to kind of go over. There's a lot of basics that are going to be involved in these particular three categories. But I want to talk a little bit about the fundamentals, current fundamentals of the market, and what fundamentals are most important to me whenever I look at my marketing. Technical aspect, I want to see what the analysis is from a technical standpoint. We don't all have to be technical gurus, but we at least need to understand how the technicals factor in to what price direction we might be looking at moving forward. Things that we don't want to ignore, so to speak. And I want to see, if we look at fundamentals, we look at technicals, what things are most important, and how do I use these tools to maximize my profit, my return on investment. Call it what you want, but I got to know what am I going to be able to do to maximize revenue on my farm and be able to latch on, for instance, in a year like 2021, to profit margins we simply haven't been able to latch on to at this point in the marketing year for 7 or 8 years. And so let's dive right in on fundamentals. I want to start with what the USDA gave us in the month of January. Now, keep in mind that I'm actually recording this before the February crop report was released. And so I want to talk a little bit about the price summary that the USDA gave us in the month of January. And they essentially said that, your corn price on average is going to be around $4.20, soybeans around $11.15. These are cash prices on average throughout the Corn Belt. And so, as I sit here and give this presentation at the current time, those price levels are actually significantly below most producers that I work with as far as those average prices are concerned. You can see several of the other ones as well, but we're going to focus mostly on corn and soybeans here today. Production summary. Interestingly, you've got a corn and soybean crop that are over 500 million bushel larger than last year. Okay, so last year is in the 2019 crop. So the 2020 crop was over 500 million bushels larger, and we're talking about significantly higher grain prices, than what we were visiting on just a year ago whenever we were in San Antonio talking about marketing 101, because I know that the prices were over $1 lower on almost $2 lower. Now we're talking about corn and soybeans, of course, several dollars lower. But production summary, hey, we're up over 500 million bushels, and we're still talking about a big price rally. A big reason for the price rally: corn exports, as you can see, year over year at the far right hand column, 772 million bushels in excess of the previous marketing year. Soybeans, 548 million bushels. So what we've seen is export demand has increased significantly. If I look at a U.S. corn supply and demand balance sheet, this is one of the things I always want to look closely at whenever I'm looking at the fundamentals that are most important for me as a producer to at least understand. How's the balance sheet look? You can see here what the forecast is, and essentially what the USDA said in the month of January was ending stocks were going to be 1.552 billion bushels. Now, my gut feeling is the February report, which will be released in a few days from whenever I record this, is most likely going to show a significant decrease in ending stocks. Now, how much is significant is anybody's guess, but I can tell you in the month of January, they extracted 100 million bushels for exports. They extracted some for ethanol as well. As you can see, 100 million bushels there. So they took 250 million bushels of demand out of the ledger. And part of the reason is, in my opinion, they had to drop production so significantly. They felt that, the lack of supply was going to drive price up enough that it was going to ration demand, which high prices typically do so. But that's what a supply and demand balance sheet looks like from the USDA. If I look at my personal supply and demand balance sheet, I'm going to look in the middle of this screen on the yellow. That is the ag market, which the team that I work with as far as brokerage and consulting goes. We actually came up with around a 1.3 to 1.35 carry out. That's what we were suggesting as far as this February crop report is concerned. Part of the reason that we did so is that we took the 100 million bushels that the USDA extracted in January for exports. We actually put those back in, and we went up another 100 million bushels. So we're at a 2.75 carry out. If you look at this, you take the ending stocks number that I've got posted here into next year with 92.25 million acres planted, and you can see even a 182 yield gets you, about a 1.317 as far as your carryout's concerned. So if you do end up at a 1.3 or below, that puts a significant amount of pressure for big time acreage here this spring. Corn stocks to use ratio, if we look, the stocks to use ratio from the month of May, this is the forecast for the marketing year we're in currently. We were up at 22%. We were talking massive stocks to use. Some people were talking 3.3 USDA. Some of your private forecasters were saying 4 billion bushels. We're currently just wondering if we can stay above a billion bushels. But, 10.6% was your stocks to use ratio in January. My suggestion is that in February, it's going to be below 10%. We'll all know that whenever we view this later on. As far as the Chinese, what's going on in China? So you're asking, this Chinese demand has just been huge this year. And we all know phase one, all kinds of different things from last year, a lot of political, posturing and positioning. But what did the Chinese actually do is what I always want to pay attention to. And so their domestic consumption for the last several years has outpaced their production. Yes, they do produce corn, not near as good yielding corn as what we do. They're a little behind there. Are they going to catch up eventually? Maybe so, but they are consuming so much corn that the difference underneath the ledger there, as you can see, that's where they're going to come in and have to import corn. If I look at what their prices are at a couple of different markets that the Chinese have, they're looking at over $10 corn. Whereas they can buy corn out of the Gulf at the time that I made this presentation at about $6.38 a bushel. So why are they buying U.S. corn? Because it's cheaper than what they can buy domestically. It's incredible what they've seen as far as corn prices are concerned there in China. I want to look at world soybean supply and use. So beginning stocks there, 112.8. That was the 1920 marketing year. 2021 coming out of it, the projection is 84.3 million metric tons. So a significant drawdown in stocks. You're seeing a demand outpacing supply to a very large tune. That's a really good thing to see. We've seen really good supply. We've just seen better demand. The soybean supply and demand balance sheet, you see for the forecast, basically 140 million bushels was your ending stocks in January. Once again, I expect for February that was going to get trimmed a little bit. How much can you trim though when you're already at a 140 and your stocks use ratio is at 3.1%? Those are awfully snug numbers, and it's pretty tough to really get to slashing too hard there. And if the USDA stayed at 140 in February, it wouldn't surprise me, just simply due to the fact that there's got to be a baseline number that they're going to work with eventually. The number that I came up with my team was 114 million bushel for the February report. Whether the USDA was going to be willing to go that low or not, we'll all know. But the bottom line is 114, 140, you name it. If you come over here with 91 million acres of beans, and let's face it, 92 and a quarter and 91 million, that's a lot of acres planted in total. Yes, we're going to get some prevent plant acres come back in this year. Yes, there's going to be people chasing profitability, so we're probably going to have expanded acreage. But the bottom line is with 91 million acres and a 50 bushel national yield, you're still only looking at a 174 carry. That's what your soybean stocks and stocks to use ratio looks like going into January. We're looking at the lowest types of levels for stocks to use ratio we've seen in a long time. So that's the fundamental analysis. Essentially, we want to know what are your stocks use ratio? How much stocks do you have available in the US and the world compared to how much we're using? That's what your stocks use ratio is, because that's what buyers look at. That's what they're concerned with, because that's essentially what is going to determine price moving forward. Technical analysis. If I look at a March corn chart, putting a chart together as we came through here, obviously there's going to be some adjustments as you view this, because March corn, will be going into delivery as we make the actual presentation for Commodity Classic. But the bottom line is this: we've seen the markets were in the doldrums. You get in the month of August, and it was just, most of us were wondering if we were going to make any money in 2020 once again. And then the market started this steady climb. It did it because these huge exports into China. It did it because our crop didn't end up being near as big as what we eventually or originally thought it was going to be. Part of the reason as well, Ukraine and Russia had weather issues. There's a lot of things that played into the fact that this market, continues to climb. I mean, essentially what you see though is that whenever you get into some of these levels, eventually taking the escalator up can sometimes lead to taking the elevator down. So we have to understand that, as a producer, as the market climbs and you look at some of these charts, you don't have to be an expert here, but looking at where you came from sometimes can help you understand. You can go right back there very quickly. The soybean chart, you look at the same type of thing. And so it almost on the same trajectory is what the corn chart, but the bean chart obviously shows a $5 rally. You took this market almost to $14, significant rally in the soybean market. If I want to look at, the corn chart, how can we use charts? We can compare to other years. And so the guys on my team put together a chart 2008 versus 2021. This is for March corn. So a lot of March corn is going to be decided by the time we view this, but you can see March corn actually reacted very similarly in 2021 to what it did in 2008. And so you got to ask, is it going to follow 2008 all the way up the ledger, to 576? And quite frankly, we weren't too far from this as I made the presentation. So, this corn situation has been very interesting, but maybe not even quite as interesting as the soybean chart. So I look at the soybean chart versus 2008, and 2021 almost mirrors exactly the kind of movements that we saw in 2008. The interesting thing in 2008 is after the January report was released, we went back down and we were actually below $12 back in 2008 and went up over $15.50 by the time March went off the board. Just an incredible move in the market. Is that something we're going to see for this year? Is that something we're going to have experience from the time I make the presentation to the time that we actually present it? That's the thing that's going to be really interesting. But you can see that this market changes very significantly, very quickly. And again, we can see where we came from. I find this slide very interesting. So, I look at a stocks use ratio. I told you before we were at 3.1% on the Jan report. On the no-DC report, we were around 4.2%. But if I look at the last time that U.S. stocks use ratio was this low, you got to go back down to the 2012-13 timeframe. Look at the last time that world stocks were down at 23.4%. You got to go back to the 2012-2013 timeframe. And so you look at a historical chart. From a technical standpoint, you look at just the chart, and again, you look at $17.50 to $18 back in 12 and 13 is where you topped out at. If you were basing what you thought prices were going to do based upon what stocks use ratio were both for U.S. and world, it would suggest that we should rally more than what we saw going into this $13.50 to $14 plus area. But at the same time, a lot has changed since 2012-13, and that South America continues to bring huge production, even bigger production almost every year to the marketplace. Let's talk about some of the tools we can use, because this really is where the meat of the presentation comes in at, because I think there's a whole lot of different ways to look at marketing. I need to understand the fundamental standpoint of marketing. I need to understand there are technical indicators that might be able to help me, and that there's certainly people that trade the technicals in the market religiously. I also got to understand, though, that none of that really matters as much as knowing my own operation how do prices affect my operation? And so we got to first define, what is risk management whenever it comes to my particular operation. It obviously it's just simply spreading out the risk of selling grain. And so I want to figure out a way that, I'm not putting all of my eggs in one basket. What are some of the different things that I can do as far as risk management is concerned? I can forward sell. So if I'm a producer, maybe I don't have a hedge account, maybe I do. Regardless, I can forward sell at the elevator. We all know that. Now, in a year like 2021, how much do I want to forward sell? Given the fact that we all feel like the cash corn situation is going to be extremely tight going into fall harvest time frame. Maybe I don't want to forward sell too much. Maybe I want to do something else. Do I want to do a basis contract? Probably not. I would rather lock in a really strong basis. A basis contract could come in really handy when we feel like the basis is as strong as what it's possibly going to be. Now, hedge to arrive is another contract, whereas the basis contract, we're simply locking in basis, and then we're susceptible to what the futures market does. Hedge to arrive locks in the futures, and then we can lock in basis later. So, a producer who maybe doesn't have a hedge account, trying to figure out a way to manage some risk, they might go to the elevator and say, hey, what do you charge to write a hedge to arrive contract? With a hedge to arrive contract, I lock in a price basis the board, set the basis later. And the nice thing is that if I'm hedging that grain at that price, if the market goes up significantly, I'm not paying a margin call. That is up to the elevator system to cover that margin call. And I'm simply locking a price in, setting basis later. Now, if I do futures, okay, so if I did a hedge on futures and it's my hedge and I hedge basis the D's at 450 and we go to $5, then I have a margin call to make. Yes, I still have the value of my cash grain growing, as I'm making margin calls, which is what the hedge essentially is, but I'm the one that is funding that hedge. And so you've got unlimited risk, but you can use it for a true hedge. Obviously, they can be used for speculative purposes as well, which we're not going to be recommending here today. As far as options are concerned, options are more of a limited risk basis, and there's a limited reward. So if I want to, for instance, put a floor under my prices, but I want the opportunity to participate if the market goes up, I might buy me a put option. And so if I buy a put option close to the market, if the market's at 450 and I want to buy a 440 put option, it's going to be pretty expensive. If I want to buy a $4 put option, it's going to be significantly cheaper, but my floor is 50 cents under the market. So there's a lot of different ways to look at options. You can buy options, you can sell options, you can put together strategies. We're going to go over a couple of those different ways to do that as we get through this. So some of the essentials from my vantage point, from a marketing standpoint, that we have to focus on is that I, as a producer, have got to look at my business as an operation. I've got to understand that my return on investment, my bottom line, those are all things that are very important to the business sector. We know that in the US, there's not too many people that can not know their cost of production and still be able to function and do well from a business standpoint. I've got to look at my operation in black and white, spreadsheets, you name it. I got to know whether I'm making money or whether I'm not. It doesn't make a whole lot of sense if I don't know, for instance, what my situation is. So knowing and monitoring cost of production, again, is essential. It's absolutely essential to know, what does it take for me to be able to make money? And if I don't know my cost of production, I don't know what I'm going to need from an output standpoint to be able to make money on my operation. So projecting production is something that we have to put together once we know what it costs us to put a crop out. So, I'm a farmer as well, and I will tell you that every year, essentially since I've been out of college, I've tried to monitor and look over, how can I get better and more efficient at being able to lock in profit, lock in net income. One thing that I did, being in the grain business, okay, so we're in the grain business up until 2009, and then I managed that system for another 5 years for the people who purchased us. One thing that I did is I tried to monitor and watch the guys and gals that were really good marketers. And one thing that I could tell you that they did well is they knew when they were making money. So they knew their cost of production, and they were really good at trying to keep an updated projection as far as what their production was going to be. And so once you've got those put together, you can establish a break even. And what a break even is, a break even doesn't necessarily mean that you're not going to make any money on the farm this year. You may have, as part of your cost of production, a salary built in for yourself of 75, 100, $150,000. I don't know what it is. Everyone's different, but you should build in a salary for yourself, especially if there's no off-farm income involved in the operation. You've got to know what's my cost of living, for instance. But once I figure all this out, I can get a break even. Whenever I get a break even, if I'm above the break even, whenever it comes to the price in this year through the start of 2021, most all of us have enjoyed above break even prices. If you choose not to sell it above break even prices, essentially the onus is on you moving forward if the market ends up breaking. So how do we get started on all this? As far as gathering costs, some of these are going to be fairly simple, but the bottom line is this. Every farm can be figured on an individual basis. I understand that. But essentially, I want to know when I throw everything together, what are my costs? So fertilizer costs are going to be a little bit easier. If I've got $150,000 fertilizer bill and I'm farming 1,000 acres, I know it's $150 an acre. Chemicals, all of this, we have to figure out what is the total cost divided by my 100% acres. Okay, so the acres I'm going to be able to collect my crop on are what I'm going to be most concerned with. I've got to identify total equipment costs. And so my equipment costs, if I want to figure that out, whether it's a lease is going to be fairly easy to figure out. If it's already paid for, you can just figure out what are you actually spending on it. Opportunity cost is something that you can use. What I want to know at the end of the day, though, is what am I spending versus what I'm getting back in return. And so, again, family living expense and off-farm income have to be included whenever I'm figuring out what my break-even levels are and my costs are. Land expense gets a little tricky because we have to know with land expense the different shares. So we know that cash rent, you pay a cash rent. Sometimes we've got a 50-50 lease or a crop share lease or a 1/3, 2/3. Regardless, I've got to know what the share is for me, and what that's going to cost me to get that share. Projecting yields, in my opinion, we have gotten so much better at being able to project yields with some of the technology, the thermal imaging, using some of the tools, for instance, that climate offers. I've been able to project yields better than ever, and in leaning on my seedsman and my agronomist, has helped me significantly as well. So typically in the past, if we were within 15, 20 bushel as far as our corn yield, we felt like we were doing something. Whereas the last couple, 3 years, we've been able to dial it in a lot closer than that. So whenever I project yields, it's very important because if I've got a higher yield, I'm spreading those costs out over more bushels, which lowers my break even. I'm going to plug that into, for instance, I've got an ag market app. We've got the profitability calculator on the channel site. I'm going to show you what the output on the profitability calculator that's on the channel website looks like. But I've also got, for instance, with my app, it's a working app that I run through. And you know what? I end up showing that bottom line is whenever it's all said and done, I can take my situation and show you whenever I increase yield, how much it lowers my cost of production or my break-even price. I can show you that whenever I make a sale, how does that adjust and affect things? So looking at different costs, like for instance, with land costs, if you're deciding whether to farm or not, my personal opinion is that, you don't necessarily need, you probably, if you're trying to farm or not, need to do an opportunity cost and know what the top cash rent is. But if you already know whether you're farming or not, I don't need an opportunity cost in there personally. Everyone's different. You can do it the way that you want to do it. But, if I've already decided that I'm going to farm, I simply have to know what my land cost is. And if I'm looking at all crop share paid for land, the only cost of land is going to be property tax. And so if we've all got, ground that's paid for and we don't owe anything against it, you're probably not even watching this, but if you are, good for you, and I'm happy for you to be in that particular situation. But most people don't need as much marketing help whenever, or at least they don't feel like they do whenever all their ground's paid for. So when money's owed or a person has cash rent or a combination of 20 different leases, it does get more complicated, but we can certainly figure it out. And it's something that the guys on my team do on a consistent basis because the power of the information is quite robust once you're able to put it all together. And so this is just a simple example. Now, I say simple because obviously examples can get much trickier. So you've got, obviously you're 100% cash rent farmer. It's just, what are you paying for the cash rent per acre, on the acres that you're collecting on? And so $250 an acre. What if you're half cash rent and half 50-50? As far as the cost for land goes, then that is essentially going to, if half of the 100% acres are cash rent and half of the 100% acres are 50-50, which means you might have 600 acres, of cash rent, and then 1,200 acres, of 50-50. But regardless, it lowers your land cost because you are not paying any cash, to get a hold of that land and to be able to get the opportunity to sell the crop off that. If you've got cash rent, ground you're paying on, and 50-50. And so, I spell out the situation here. $250 an acre cash rent or 50-50 with no land cost is going to be on a portion of it. The owned portion, if you're paying $100,000 a year divided by the 400 acres, it's your 1/3. If you're in that situation, then obviously it puts you at a land cost that's higher than the 50-50 split, but it's significantly lower than being all cash rent. Now, if you're paying on some ground and you've got cash rent, you don't have 50-50, that's going to be the most expensive one. We all know that paying on land takes a few acres of rented ground to help you pay for it. But as you can see the math here, you end up at a $270 an acre land cost. Now, we all know that that's not the highest land cost we've heard. There's, especially in the year like 2021, land cost is something that has crept up just a little bit due to commodity prices going up. But regardless, you can see how I put the example together. $583 an acre is what it's going to be for the ground that you're paying for. Whereas your cash rent again is going to be the same thing it was before. And so whenever you net that all out, $270 per acre. If I look at an example as far as equipment's concerned, okay, so you've got to understand, if I've got farm ground and I've got some cash rent land, I've got some 50-50 land, if we're going to look at, for instance, a tractor situation, whereas it's $10 an acre to run it, if it's a 50-50 situation and I'm not paying the cash rent, so I know that I've got the ability that I'm not paying to rent the ground. I also have to understand I'm only getting half the crop. And so the cost to run that tractor is twice as much than what it is on my 100% acres. And so if I want to figure this all up, it's essentially going to change what the cost to run that tractor is based upon what my share agreements are. You can see combine, tractor, planter, it's all the same. Essentially, if it's owned, it's 100%. If it's 100% is what you're gathering, and it's also going to be the cost to run that tractor. It's twice though, whenever you're talking 50-50, and it's something that we have to keep in the back of our head because we're only, once again, collecting on half of those acres. If I want to look at equipment costs, just to help you out, I know there's various places you can look for these things, but if you go to Farm Doc and looking in this presentation, I don't know if you can click on the link or not, but certainly snapshot this, go to Farm Doc and look what the machinery cost estimates are. And I believe they've got updated estimates for 2020, or they will by the time this airs. But bottom line is they're not going to change a whole lot year for year. But bottom line for me is that I want to keep very, very close tabs on what these rates are. If I've already, if I'm a producer who has my equipment paid for and I want to be putting some equipment costs in there for my own purposes, I want to look towards here. Now, if it's me and I've got, I have some paid for equipment, I've got some leased equipment, I've got a variety of different avenues, but I want to know for me, if it's costing me $100,000 a year to run my equipment, I know where I want to portion those out at. I know what it costs me. I definitely have to keep in mind, for instance, am I including fuel in my piece of equipment or am I extracting it? For me personally, I extract it and I do fuel costs as a standalone. A lot of our expenses we can take off of the previous year's taxes, and we know what we ran the previous year. If we haven't changed acreage, we know we're probably going to be looking at very similar costs as far as fuel goes. Hopefully repairs go, but we know that that's a fluid situation, supplies and so on. So I want to get into some more specific stuff. So just to talk a little bit about what were we looking at before this rally actually started, okay? if I was looking at an all fall bid in my part of the world, this is posted on ADM Decatur bids. So that's where Farm Progress Show is. It's just 40 miles up the road for me, and it's the processor end user that a lot of folks in my part of the world use. Going into harvest, their basis was 15 cents under the board. That's something to remember and to keep in the back of your head. 305 was the cash price. You look down at soybeans, and you look at, for instance, they did have a quick ship for both beans and corn. I think these quick ship bids are going to pale in comparison to your quick ship bids for 21. But regardless, you see the all fall bid for soybeans too, 872. Call it what you want, but again, basis was running under coming into harvest. If I look at a bid that was just a couple of days before I made this, actually one day before I made this presentation, I look at the cash corn bid of 567. So I was actually $2.62 above what we were coming into harvest time frame. The other thing, basis is 15 cents over the mark. So what you experienced here this year is you had a crop that was bigger than the previous year, and then you rallied $2.50 throughout harvest and then some, and then you also saw basis improve at the same time. It's just not typical. It's not something that you're going to see every year. Maybe not see it for quite some time still. It is an extremely dynamic year that I think we're going to be looking at for quite some time. Some major shifts in demand, but it's been an enjoyable ride. And there's a lot of things we can learn from a year like this, as well as with soybeans. You look at basis, of course, was 10 over, whereas we were 10 under coming into harvest. Now, if you look at both corn and beans, as you get farther out, basis is actually just a little bit better the farther out that you go. Part of the reason is that we've got, as you can see over to the far right, a bit of an inverted market. And so that means that the front months are a little bit higher than the deferred months, or March corn is higher than July corn, for instance. And so in that particular situation, we're looking at a 15-cent inverse on the corn, from 552 down to 537 for futures. And so what do we see happening? Well, the end user is saying, you know what, we're going to keep basis fairly strong, because I feel like the end user is just a little concerned about what your origination is going to look like farther out into the calendar year. So let's plug some of these numbers into a profitability calculator that happens to be on the channel website. So if I look, and I put this spreadsheet together back in before the calendar turn, so it says 2020 corn profitability, and by all means, this is based on the 2020 crop. If I look at a producer with a yield goal of 225 that ended up with 225 bushel corn, and the cash rent and land cost is 200, chemicals of 55. You can see the different costs here, 170, 110, 200 for additional costs. As you can see when you go on the website, it's customizable to an extent where you can throw any cost in there that you really want to, but it's going to include your crop insurance, labor, all of your different expenses. And so as you can see at the bottom, it shows you per bushel what you're spending on these different items. It also tallies it up. So 327 happens to be your break-even price, because that's what you're spending to put the crop out at 225 bushel corn. Now, at $3.05, whenever we were coming into harvest, as you can see, a producer on 2,500 acres, he's looking at $121,000 loss. Is part of the reason that I was not interested in making many sales coming into harvest. As far as corn was concerned, net profit per acre, of course, was about $50 an acre in the red. Let's fast forward to today, and I know that a lot of us sold as we went through here. Went through harvest. We were saying as you go through harvest, if you sell across the scale, re-own the corn, we felt like it was good property. But at the same time, I can tell you that my corn strategies weren't as good as what my soybean strategies were, or my foresight, if you will. So if I look at corn, same break-even price, because all the costs are the same. Unless I change my yield, my cost structure per acre is not going to fluctuate or be any different. But if I look at the grain price at the date that I posted, for the grain bid, 565 per bushel, that shows you that the net profit per acre is $536 per acre. That's on these particular bushels. Okay, now if you had some bushels that you sold maybe even at a loss or at a break-even standpoint, the bottom line is this: if you've still got bushels, you can average these out. We know that. And so it's very interesting to look at the differences and how this has fluctuated, because obviously instead of losing 120-some thousand bucks, you're making 1.3 million if you'd held on to all your corn. Nobody that I know held on to all their corn, but certainly there's been a lot of corn that's been held onto in bins that producers have kept tight-fisted. I think the producer here in early 21 has more money in their pocket than what they've had in several years at this time in the calendar year. It's part of the reason they've been tight-fisted. If I look at 2020, soybean profitability is a little bit better situation than the corn one was coming in, with very similar costs. Cash rent land costs at 200, chemicals at 85. Why did I have them so high? Because most producers put fungicide on this past year. And so I did attribute a little bit of fertilizer there. But if I look at this at a 72 bushel yield, and yes, this is in central Illinois for us, we're going to forecast a fairly robust yield. We've been blessed with amazing yields these last few years. That gives me a break-even price of $7.79 a bushel. Coming into harvest with an $8.72 price, I had net profit per acre of 66 bucks an acre. It's part of the reason I was selling some beans. Did I sell too many beans early? You better believe I did. But was it too early? If I was making money, that's one thing we got to be cautious to get our heads wrapped around, is that if we're making money, it's not too early. You know what? If my worst sale is my first sale and it's profitable, I'm gonna have a pretty darn good year. But let's look and see what happened after the market rally. Whenever the market rallied and you're looking at $13.70 a bushel, you know what? $425 an acre net profit. So $1 million plus as far as your soybean net profit's concerned. So what is necessary for an effective marketing plan is you start to think about, well, what am I going to do for putting together my marketing plan for 2021? What are the different strategies I might do? One thing you've got to do is you've got to control your emotions. And whenever I talk about controlling emotions, typically it's fear and greed we talk about, because we're always fearful we're going to miss a market. How many producers have you talked to this year that say, well, you know what? Cash beans are $13.50 and new crop beans are $11.25. Why would I sell beans when they're $2 below cash? Well, why would you? Because you can make more money at $11.25 selling those in the month of February or March than what you've been able to make for the last several years. And so does it make sense to latch on to some of that? Yeah, I think that it does. And so you've got to figure break-even prices, though, using your cost of production. We've already talked about that, but I want to know exactly what those are. What's your marketing plan based on the break-even? So if you're going to go to all that work to figure out what the break-even is, how can you use it? Well, you use it in your marketing plan. I want to set goals. I want to benchmark myself, make sure that I'm trying to at least be in a situation where I know I'm locking in income as I make incremental sales. And then you have to stay disciplined and execute the plan. So when you put a plan together, the frustrating thing for a lot of us is that we put really good plans together and then we don't stay disciplined and execute the plan. And so, when the market moves up 50 cents, we say, I don't want to sell anymore. I want to go ahead and move that offer up. Well, be cautious with that, because if you're making money at that price, let's live to play another day later and hope that we can sell at a higher price yet. I got to keep tabs on break evens as I make sales. So if my break even is $3.60 a bushel for 2021 corn, and I sell a bunch of corn at $4.25, guess what? My new break even is below $3.60 a bushel. It's something I need to be very cautious and know how that works. Base your decisions on profit and not price. Why do I say that? Because way too often we say, you know what? Yeah, I like $5 corn, but I'd like to get $5.50. Well, you know what? If you're making $250 or $400 an acre at $5 corn, why in the world are we having this discussion? And so use your bins wisely, and we'll go over in detail what I mean by that. That's what a marketing plan looks like for a typical producer. And this is conceivable, and so what do I want to do personally? I'd like to be around 15% sold by the end of the calendar year, the year before I harvest. Now, the thing for me is that in a year like 2020, when we had such big opportunities to lock in profit, producers that were up to a third sold by December 31st, I can't persecute them for that. If they can be in a situation where they're making money, there's no reason, in my opinion, to be too bashful about making those sales. You can see my target percentages sold. These are adjustable, and it's for anybody to choose what they want to do. But I want to go ahead and log my sales. I want to log the bushels I sell, keep a running total of it, know what my percentage sold is, know what the effective price is. So if I'm hedging, I want to at least forecast what that effective price is based upon my typical basis or what basis I expect to get that year. But that's what a typical marketing plan can look like, and it's certainly something that we try to to try to put out and try to help people put together. Maximizing storage return. So if I look at basis during the fall of 20, of course, we start at 15 unders. I showed you right now basis is 15 over the March. So whenever Dees went off the board, the carry from Dees to March is about 12 cents. So how much is basis improved? About 42 cents. And so basis has improved significantly since we went into harvest. If I look at how that's affected cash prices, it's obvious it's gone up 305 to 567. But I have to, as a producer, consider how a grain elevator makes some money. If I've got bins on the farm, I want to manage those bins like an elevator manages their bins. And what do? You know what? They try to buy the grain when the basis is wider, and then when the basis narrows and they're getting more in relation to what they paid for that grain from the end user, that's when they want to make their sale. And they want to make money on basis, make their bins, make them money. And so the owner of cash corn is king. In 2021, you better believe the owner of cash grain is going to be king. There could be some significant opportunities later in the year. I think that we're going to be extremely tight on supplies, regionally speaking. How much can a basis impact a producer's income? This is a 2,000 acre grower, 200 bushel corn. They can store 75%, and so they can store 300,000 bushel. The harvest basis is 30 under with these at 470. Cash would be 440 in that situation. So 30 under. I know we were 15 under this year, but this is for example's sake. This is very typical for us to see 30 under basis in my part of the world during harvest. The carry from Dees to July, though, for the producer is about 30 cents. And why is that important? Because if the producer's sitting here with 470 corn and they say, you know what, July corn's $5, I think I'm going to go ahead and sell $5 corn, as you can see at the upper right part. I'm going to sell $5 corn on a true hedge. So I hedge it on the board of trade. That means that I'm susceptible to margin calls. That means all kinds of fun stuff. But what it does mean is I'm locked in at $5. Worst case scenario, basis the board, on the 300,000 bushels I can store. July futures rallies to 530, which necessitates a margin call on a 300,000 bushel position of $90,000. Now, you're not going to get it all in one day unless it moves 30 cents in one day, which would, right now, our limits are 25 cents, so it's not going to happen. But basis improves to 10 over the July in this scenario, okay? So the basis goes from, as you can see, a sub basis to a 10 over July basis, making your cash price at the end user or wherever you're selling $5.40. And so if you would have sold 300,000 bushels originally at the 440, you would have gotten $1.32 million up front. Yes, you can pay bills. There's a cost of interest. I totally understand that. Or you could have sold your 300,000 bushels at 540 cash price. You have to take the margin call off. So you have $1.62 million. Take the margin call off, you got $1.53 million. So the carry from these to July accounted to about $90,000 of that $210,000. The basis appreciation accounted to about $120,000 of that $210,000. As you can see, in a typical year, bins can pay big, big dividends. Look at crop insurance real quick. We have to talk about it. My estimation is that your February average is going to be around 450. As I made this presentation, we were a few days into the month of Feb, and that's about where the average was. Now, who knows where we end up, but it's probably going to be within earshot of there. So the 2020 spring price was $388. The 200 bushel APH means that I've got $105 an acre more than I'm going to be able to guarantee at the 85% level. And I know some folks go 90, some folks go 95. I did 90% last year personally. My personal opinion is the higher price gets, the more I want to insure. It is a subsidized program, and it does offer us opportunities to be able to manage risk that we can't really duplicate elsewhere. 2021 spring insurance price for beans $11.50. Again, it's an estimation. Actually, that's a little bit below the average that we're currently seeing, but anyway, I just threw a nice round figure out. So the 2020 spring price was $918. As you know, that's a big, big difference. So 65 bushel APH grower, $128 an acre less guarantee at 85%. So you can see that we're able to guarantee more. If I can guarantee more, I want to be able to use that insurance to give me an opportunity to sell insured bushels that I know I'm going to have available. So some marketing ideas. You know what? A straight hedge. I can sell these corn right now. I can sell these corn and buy calls. The difference there is that I'm selling these corn, and if the market goes up, I know that that's the price level I'm going to be at. If I buy calls, I'm going to participate in a portion of that upward movement. I could forward contract, and I could forward contract at the elevator, or I could also forward contract and buy calls. Okay. The only problem with forward contracting for me this year is the fact that I think basis could be robust whenever we get into harvest, the early part of harvest. I could buy put options. So I like buying put options. I'm going to show you a strategy here in a minute that I think makes a heck of a lot of sense. But a put option is at least going to give me a floor, and then it gives me the opportunity to, to be able to participate if this market takes off to the upside. I could sell calls. Why would I sell calls? Well, it's to help me pay for positions most of the time. I don't like selling calls unless I'm going to be able to use it as a hedging opportunity. And what do I mean by that? I don't ever want to sell calls unless the value of my corn that I'm either growing or that I already have in the bin is going to improve. And then I could roll hedges. I mean, there's a lot of things that you can do. A lot of folks are looking to, if I can't come up with the bushels, can I roll a hedge into the next crop? There's a lot of folks that, that essentially have done that in the past. Some elevators go along with it, some won't. And I always need to be able to look at the spread from the D's to July. And so if I'm a grower putting it in the bin and I get full carry in the market, I have to pay attention to that because it can provide me excellent opportunities. So do I want to hedge at 450? I mean, there's a lot of questions there. A lot of producers ask themselves, so giving acreage projections, what's the rally potential in 2021? If you have weather issues, is huge. There's no doubt that you could see $5.56 corn if you have major production issues here in the U.S. If you're buying revenue insurance, though, you're blessed with a really good guarantee, worst case scenario. Okay. And so you have an assurance of insured bushels. If I want to look at this, though, I've got to understand a couple of different things. Fertilizer costs continue to increase. But if you're a producer who got all your fertilizer on this last fall, you're in really good shape to be able to make sales if you didn't make sales when you were buying the fertilizer. Protecting 450D's corn, my personal opinion, it's not even an opinion, it's a fact. You're locking in the most profit in 7 to 8 years if you're looking at selling insured bushels that you're going to be able to sell. Now, what percentage you sell out is going to be completely up to you. So some specific ideas as we get close to wrapping up here. I want to be able to maximize crop insurance. I've already said that. I'm going to say it again. And if you call me, I'm going to tell you once again. I want to maximize how much revenue I can latch on to through my insurance policy. I can write an HTA with an elevator, okay? And this is an idea. These are not specific recommendations for obvious purposes, but I will tell you these are the things I'm doing on my farm. Why do I want to write an HTA with the elevator at 450 or above? Because I want to lock in basis later. I don't want to lock in basis now. I think that if I'm able to get in the field early and I'm able to harvest early, maybe even wet corn, you might see basis levels of $1 over for corn going into harvest, and 2 weeks later option price. It's something that we could see. We've seen it before, and this would be the type of year we might see it. Okay. Do I want to buy a corn call to insulate my position? Me personally, I do. I want to hedge and know that I've got a price level locked in. I'm buying the 470 May short dated call. Why am I doing that? I don't have to participate in 100% of the move, but I want to participate in a decent chunk of it. So buying put options or a put strategy. I'm going to give you a specific strategy here. And this is one that I personally use that I think that it's got a lot of, it's just got a lot of really good things about it. And so I'm willing to do the HTA with the elevator up to 20%, maybe 25% APH on put options. I don't want to get over 40 to 45% before I at least have a decent spring. But me personally, this year, knowing my insurance situation, I'm willing to push it a little bit. Buying a 450 put option and selling a 380 put, okay? So that gives me 70 cents of downside protection if this market would plummet. I'm also going to sell a 570 call, and I'm going to do 15 cents, okay? Now, whenever I say 25%, it's of APH, so it's of average production history. So in this situation, I don't feel like we're taking too much risk if we're maxed out at 570 on 25% of production. The nice thing is the floor is at the market, and it gives me the chance to run upside over $1. The farther I get into the growing season, the better I feel about my crop, I'm going to aggressively market. Specific ideas for beans, same exact thing, but the HTA, as far as beans are concerned, is around 1160 or above. That's basically the price of the day that I'm putting this together. 25% of APH, I think, is a really good idea. Do I need to buy calls there? Me personally, probably not. Calls are awfully expensive on beans. I can make a ton of money basis the board at 1160 soybeans. I feel pretty comfortable just simply hedging that. If I'm going to do a put option strategy, though, I kind of like the idea of lowering the cost of that strategy. A very similar strategy to the one with corn. I'm buying 1160 put and selling a 1020 put. It gives me $1.40 of downside protection. I'm going to sell a 1340 call, which gives me the ability to participate in $1.80 of upside. That position for around 20 cents means that my true floor is 1140 a bushel. That's pretty tough to beat, especially whenever I have the opportunity to still sell $13 beans if the market goes there. Once again, I'm going to aggressively market as we go up, as I feel better about my crop. So as I close here, I just want to make sure we always keep things in perspective whenever we're doing our marketing. Yes, we've got to understand all the different aspects of the market, but you've got to keep your marketing situation in perspective. 21 is a great time to do so. Go back and figure out what your situation was in August, figure out what it is now. That's what you call perspective. Our situations changed significantly. In a year like 2021, we have to play offense, okay? I'm not saying you just get super aggressive and market all your crop. What I'm saying is I want to be able to lock in my situation on a worst case scenario basis, keep flexibility in the event the market goes up. You got to have a well thought out plan put in place. And my personal opinion is if you don't have it by the time you're watching this, it needs to be done rather rapidly. I think that whenever you get into the March planning attention situation, it could get pretty dicey, especially if we have really good weather this spring. We can see our fortunes change just a little bit. And I always want to tune out everything other than, can I make money at today's prices? That's got to be the question that we ask. If I can lock in revenue, then I've got to ask myself, why in the world am I not doing so? So questions and comments, we're going to take questions as I wrap up here, but this is a good way you can get a hold of me. There is a newsletter that channel puts out. As you can see, you can just simply text this grain to 242665 if it happens to be channel without the E in it. And then you can also find the profitability calculator on the channel website if you want to look for the profitability app that I was talking about that I developed as well. And it's basically the profitability calculator channel puts out, in app form that I market personally. So if you want to do that, you can see it's agmarket.app. So I'm going to show my risk disclaimer, just cover my own rear end. And then as we wrap this presentation up, I'm going to be available to answer any questions that you may have.